All right, and we're live. I want to welcome everyone to today's webinar on digital asset data and infrastructure hosted by The Block. Today's webinar will feature a discussion among leaders across the enterprise digital asset landscape, and we're delighted to welcome, who's having issues, I think, joining, but he'll be here hopefully soon, by Adam Trademan, CEO and co-founder of Blockset, by Bread. We have Sal Ternullo, co-lead of KPMG's crypto asset services team, and Rebecca Aspler, Director and Product Manager from Unbound Tech. So we're going to start out by having our panelists do a short presentation about where and how their respective organizations fit within the digital asset infrastructure landscape. And then we will roll right into a panel discussion that will be moderated by The Block's Director of News, Frank Chaparro. A couple of quick housekeeping items before we begin. We're planning on having an open Q&A session after the panel discussion. So we're asking participants that have any questions during the discussion to please submit during the conversation, and we'll try to get to as many of those as possible in the Q&A. And then also be on the lookout for the option to answer a polling question or two during the conversation. So with that, I think I'll turn it over to our panelists to do introductions. Sal, would you like to kick us off?
Yeah, that's great. Thank you for setting up the stage, and appreciate the time to join everyone here today. I see we have Adam with us as well. So, you know, as Ryan mentioned, I co-lead our crypto asset work at KPMG around a full life cycle of advisory services from strategy through product innovation, design, development, and enablement. And we've been specifically focused on the custody landscape and digital asset infrastructure landscape, which leads us to this conversation today. So looking forward to providing a quick viewpoint and setting the stage, and then diving into the panel discussion with the team here.
Thank you, Sal. I'm Rebecca Aspler. I'm Director of Product Management at Unbound Tech, leading the blockchain product line. Unbound Tech is a proud leader of cryptographic solutions for the enterprise security world and for the blockchain world.
And then Adam.
Folks, can you hear me? I can't hear anyone.
Yeah,
we can hear you.
Good.
There he goes.
Why don't we have Sal start? Okay, he's back.
This is the reality of the dispersed world in which we are now living. But we'll hopefully have Adam online to introduce himself shortly.
Yeah, let's just have Sal start with his presentation.
Now, I guess we can just kick off. Yeah, we'll kick off with the presentations.
All right, awesome. So before diving in and talking a little bit more about the work that KPMG is doing in the space, I think setting the stage in terms of the trends that we're seeing in the market in 2020 will be helpful. KPMG has been in the business of institutionalization for a period of time, looking all the way back to 2018. And I think over the last 2 years, we've seen a rapid maturation of institutional grade custody products and services in the market, and increasing adoption within the financial services space. These are largely buoyed and driven by the increasing insurance coverage and nature of policies that are driving support and preventative controls around these types of operations. Alongside this institutionalization, we've continued to see robust financial product innovation from traditional markets with respect to futures, adoption primarily in cash settled contracts, but also with physical settlement in options like backed. We're increasingly in the top of every media headline today is the topic of central bank digital currencies. The question around how do you adopt stable coins or some type of derived digital instrument. And then from the financial application perspective, if you look into the DeFi landscape, a lot of really, really exciting DeFi applications that are driving thinking around how middleware infrastructure built on solutions like MPC can actually enable product innovation in a central finance structure. And I think hopeful for all of the folks on the line, we continue progress along the march towards ETFs. And I think Canada has taken strides in pushing that forward. So looking itself, I think, yeah, this year is an exciting year with regard to project launches, but also with regards to adoption of novel technical advances at layer 1 protocols. So major upgrades coming to both the Bitcoin and Ethereum networks, and super exciting applications with regards to how privacy and scalability and some of the core problems or trilemma issues of blockchain adoption will be solved for. And most excitingly in the technical space, and kind of the basis of a large discussion today, is this area of MPC and how multi-party computation cryptography applied in the context of key management can transform the operational and applications and potential of custody solutions to drive innovation. And then kind of the fourth kind of viewpoint that we see as a continual evolution is the regulatory landscape, which we'll touch on here today as well. And increasing adoption and solutioning for the FATF guidance around the BSA travel rule, and understanding more clearly what regulatory structures will be as legislation continues to pass on a state-by-state basis in the U.S. Or on a global basis with regards to increasing definition of digital asset types and subsequent treatment. So across all of this, there's increased collaboration on a global basis across regulators and figuring out, what is the right approach to build a regulatory environment and policy landscape that protects markets and investors while also fostering innovation and enabling the potential of these technologies to affect, transformation across financial, economic, and social systems. So I think that sets the stage in terms of the trends that we're seeing in the market. Those 4 pillars are stay locked into and continue to research. And I think that helps to cue up the conversation around how we view the transformation of financial services in the enterprise context. And KPMG, again, has been very center focused on the institutionalization of crypto and digital assets for a period of time. And we're excited and kind of thrilled to today announce that as a culmination of the work that we've been doing in the market and through collaboration with organizations like Unbound and Bread, we're launching a capability set and accelerator called Chain Fusion that integrates core data environments around network layer transactions, exchange level information, off-chain transactions, traditional information silos around fiat currency movements, and enabling an accelerated package for analytics to serve different use cases across the front, middle, and back office of the financial services landscape. And by building this technology and incubating the capability set internally within the KPMG environment, we're building out opportunities to devise continuous control monitoring schemes, enhance security across the capability set, and also business and operational metrics and types of analytics that allow for better understanding of performance for transaction processing when using different types of signing or custody models, and what are the actual continuous dashboarding viewpoints that you can provide to stakeholders across these different components of an enterprise model in a tier 1 financial services company. And that includes, very importantly, your enterprise risk management, compliance, and audit function as well. So again, super thrilled to be here with this group today and talk a bit more about the products that are driving the analytics capabilities that we're taking to market under Chain Fusion. So I think with that, I will pass it off. Queue up Rebecca for a discussion on Unbound.
Thank you, Sal. So can you hear me? Yes, I'm assuming yes. Okay, cool. So Unbound Tech has been around since 2014. We're very lucky to have Professor Yuda Lindell and Professor Nigel Smart as both of our co-founders. And they're actually the ones to improve the performance of MPC, multi-party computation, having it being applicable to business situation, not just academia, in the sense of 30 years of research. Since 2014, you see, we have accumulated, these are just some of the names that we're serving. So very, I would say, enterprise grade type of customer, risk averse type of customers that wanted to take our software through many pen testing types of tests, many peer reviews kind of analyses, checkups, and of course, day-to-day testing. We're very proud to be having certified for FIPS Level 2, FIPS 140 Level 2. And we're also very fortunate to be defined by Gartner as a cool vendor, specifically for the blockchain product line for which I'm responsible for. Citibank, Goldman Sachs are part of our investors, and this is us as far as the names that we're serving. If you may move to the next slide. Cool. This is our blockchain solution or security platform. Very briefly, because this is, of course, we should be setting the stage for the panel itself. As you can see, it's multi-party computation, key signature, and policy management platform. Very briefly, just describing the three core components of this platform. It's firstly a robust cryptographic platform. So MPC-based approvers only hold key shares. None of them holds the one unified key. None of the keys is being computed together into one key. Everything is computed as key shares, as distributed key shares, therefore creating a platform for distributed trust. It can incorporate, we can add easily any type of asset because the signature is pretty much agnostic to the type of asset. It is considering important the type of the signature behind the scenes, whether it's, just as an example, ECDSA or EDDSA, just examples, Schnorr. The policy is distributed between the various members, and therefore it is validated between the various members. So there is no single point of failure that is or can fail to validate a policy in a malicious manner. We're serving, as mentioned, enterprise type of customers, and therefore we have to prove that signing is cryptographically validated. We offer flexible risk-based multi-party policies. None of the changes in the system can be held by a single person. It has to be a group of admins. And of course, an addition of whitelist, which is kind of commodity today. Nicely, and this is why I think one of the reasons we're in this call, Unbound, is proud to be serving our customers together with several partners, and the list is growing. Today we have KPMG on the call and BRD. But naturally, like any security platform that is the underlying infrastructure for any blockchain type of system, you must have node management, KYC and AML, market data pricing, etc., etc. So this is Unbound Tech blockchain solution in a nutshell. Adam, now it's your turn.
Thank you very much. By way of introduction, my name is Adam Trademan. I'm the CEO of BRD. Good day to everyone. We're very pleased to be part of KPMG's platform here, and today I'm here to talk to you a little bit about Blockset. So Blockset is a single API for multiple blockchains, and a platform that allows companies who want to build blockchain-enabled software to do so while saving time, getting their products to market faster, and doing so with lower risk. BRD as a company historically has been known as a consumer mobile app as the easiest way to onboard and to basically get started with crypto for new investors. We've got 4 million users today in 170 countries that are using the BRD app. And Blockset is the infrastructure software on the back end that basically services that need. And so we recently in Q1 launched the Blockset product as an enterprise product that basically uses that same infrastructure to enable companies that want to build any type of blockchain-enabled app, whether it's mobile or server-side, whether it's custodial or non-custodial, to do so in a way where they don't have to worry about things like running nodes, forks, maintenance on chains, adding new chains. They don't have to spend the time and energy to integrate with various blockchains. And they also don't have to take the risk of writing software that is handling customers' money. And so very much like I think Amazon and Microsoft did with AWS and Azure, this sort of concept of outsourcing these technologies instead of reinventing the wheel is something that really helps accelerate industries. And historically, if you look back like at Web 2.0 technology, when the web really got cool after its initial incarnation in basic HTML, that kind of Web 2.0 tech was a catalyst to create an entire new industry and all sorts of new companies to enable that. We're doing the same thing for blockchain. I think overall our industry in terms of crypto has been sort of immature, in the beginning, only because like every new technology, like the internet or like, VCR tapes way back when, right? It takes time to build infrastructure and for companies to mature and to grow up. And in order to support mass adoption, institutional investors, and to have real banks, other financial institutions really move into the space, it requires solutions that you can trust, that are scalable, that are already working today in production with millions of customers, that you can rely on in order to offer new products and services to your customers. And so Blockset is an important part of that here in today's flow that we're talking about, also used as the foundation for crypto banking infrastructure products that some Fortune 100 banks are using as well, globally, in fact. And so, when your CEO asks you to get a digital platform going for digital assets, it's good to know that there's technologies out there like Blockset which can enable that. You can do that quickly and easily. It's comprised of a few different components, which maybe we'll talk about a little bit today, but mainly, one API to access any blockchain, the ability to have like an optional white label or OEM kind of wallet, and then chain operations, which basically means the running of all the nodes and everything's kind of taken care of for you. You can move on to the next slide. Thank you. So what Blockset is designed to do is to help companies who want to develop blockchain-based software to mitigate risk and to mitigate those unanticipated costs. And, like every new sort of idea that's out there, it always starts off like a great thing. We can provide these new features and products to our customers, but there's always sort of these known costs at the top that you see there, like, we've got to run servers, we've got to have DevOps, there's all sorts of costs associated with sort of maintenance and chains and all that. But then there's all these unexpected costs at the bottom as well. So Blockset, can help in all of these aspects, and we're excited to have it as part of this flow.
Well said, Adam. Great job. Great job, everyone, on the intro presentations. Gives us a sense of what everyone is involved with, and we have a great smattering across the enterprise blockchain landscape. My name is Frank Chaparro. I am the Director of News at The Block, and we are now segueing into the panel portion of the conversation. I think what's so interesting about the subjects you all touched upon is the fact that a lot of the clients or folks you're engaging with and working with are in fact these larger institutional players. Rebecca noted Citi as being one of the clients that Unbound is working with. But at the same time, there's this weird juxtaposition in the market, I think, where when people think about cryptocurrencies, digital assets, they almost exclusively think about the trading of cryptocurrency assets or or exchange services related to cryptocurrency assets. But there's much more that enterprises and big financial institutions are looking at. I guess my first question to kick us off, Adam, when we look at what might be an unsexy topic, infrastructure, wallet infrastructure, data analytics, storage, security, vaulting, all of these things aren't necessarily the focus of mainstream financial media or financial professionals, but it is what the institutions that you're working with are interested in. So with that said, what exactly are larger financial services firms wanting from vendors like yourself at this moment?
Thanks, Frank. It's a good question. They want accurate data. They want the ability to have infrastructure software to access blockchains, to create transactions, to move value around, to look at transactions and manage customers' assets. They want the ability to do that in a way that is regulated, that is compliant, and that can scale to meet the needs of their huge customer bases. If you put yourself in the position of a large financial institution, you're already a little bit scared about technologies like cryptocurrency, right? But you want to compete with those companies that are offering things of that sort. You feel like digital assets are the way of the future. You look at countries like China that are moving to digital currencies, and you think, gosh, we need a solution for this, right? But are you going to rely on a software company that, has, some nouveau kind of crypto-related infrastructure software, but it's not proven, it's not valid? This is often the case in young industries. You get these, these sort of startup companies that are building all these new technologies. But as you're a bank, you have a responsibility to your customers to make sure that their assets are safe. You have a responsibility to make sure you can provide the service, not to 1,000 people, but 10 million people, right? And so that's what they're looking for in the industry. They're looking for scalable software that is built based on new digital asset technology, but with the intelligence and with the sort of sophistication and with the scalability of what you find in traditional fintech, traditional financial industries. And so that's where we're going with it. And that's what's necessary to take this whole industry to the next level, to enable mainstream financial institutions to really get into the crypto space.
Yeah, no, it's an interesting point. Yeah, you mentioned earlier the fact that you drew comparisons to, the technology world and companies leveraging, whether it's cloud services providers or different vendors. We've seen the same thing play out on Wall Street over the course of the past, few decades. As banks try to increase their return on equity, they have to seek out those types of vendors that can offer non-differentiated services. So in a sense, to your point, we're not necessarily reinventing the wheel here. We're trying to create services that fit the gaps for larger enterprises. But more specifically, when we think about what they need, what are the use cases right now at a big bank like Citigroup that are at the forefront? They're not trading this asset. You mentioned that they need data around these different assets or these different blockchains. Sal, what would they need data around these assets for, or data tools? What would they be doing that would necessitate the need for, maybe let's focus right now on data, we can move on to other services like custody or wallet infrastructure?
Yeah, build directly on the points that Adam was making around accuracy and trust and completeness of data. And it lends itself very nicely to a theme in a paper that we recently published called Cracking Crypto Custody, which from one of the angles that we put out in that paper was around the idea of third-party trust, where these maturing technology companies that are serving the enterprise institutional landscape in crypto need to pursue or validate the performance of their control or financial reporting objectives and or broader technology control objectives around security, availability, processing integrity, as these institutions rely on third-party vendors in the space, which is a similar maturation curve that you saw in the Web 2.0 era in these verticals. But what I would say is, as far as the data enabling enterprise use cases, it's core to everything that a traditional financial services institution does. If you look at the base of all institutional product innovation, it's all built on top of robust data products that are provided by leading global traditional financial services data providers like Bloomberg and Thomson Reuters. So the build out of what is a unique set of infrastructure requirements to provide similar types of data at scale with the similar degree of fidelity, trust, and comfort around the accuracy and completeness of that information is similarly required for any type of meaningful adoption in the permissionless context within that tier 1 institutional landscape. Just piggybacking on your point with regards to use cases, I think, the last 6 months to 9 months has actually started to see a rise in the issuance of security tokens for different types of underlying traditional financial assets to some success. Obviously, there's been less, I would say, less of an explosion in adoption of security tokens relative to what we thought in 2017 and 18. But we're actually starting to see significant issuances at this point, private placement opportunities, opportunities to tokenize large underlying real estate portfolios. So some of the solutions that are coming today and use cases in that tier 1 space are targeting some of those more known, regulated, clear circumstances. But again, the data infrastructure and the way in which we described it is a critical component for engagement in these permissionless networks.
I can actually add to that. The use cases that we're seeing with several banks are very much in the area of the back office. They have, if we're taking the permissionless blockchain outside of the picture just for a few minutes, and we're talking about the permission blockchain, we see consortium of banks and credit companies and lending companies and identity type of companies and banks within themselves, the branches, creating private blockchains to be able to clear and settle different types of derivatives, let's say equity swaps, let's say bonds, and they have to do so to be able to do it much more efficiently than before. And blockchain is the perfect answer for that. Immutable type of network. Everything is automatic. As soon as a future, just as an example, is settled, everything is being automatically cleared. No people to have to run through the different forms manually. So that's a classic use case that we've seen.
You know, Frank,
It's something I just wanted to make a quick note. It's something that we've seen Paxos work on. They have a pilot with Credit Suisse and I think Societe Generale, the French bank, where they are clearing and settling a certain number of trades through a blockchain. But before we jump to Adam's point, Rebecca, I just want to ask about scaling. We understand, anyone who knows about, T+2 and how long it takes to settle a trade know how onerous the process is. And in a world where trades are executed in microseconds, even fast, T+2 or whatever have you, is the way we are settling things on Wall Street in 2020. Yeah. But there's also this question of, can this scale? I mean, if I can't get CryptoKitties to work in 2017, how am I going to put the entire US capital markets on a blockchain? It's
going to take time. And this is why I think the banks, for that matter, as more of the risk-averse type of customers, and in a very justified manner, they are being trusted by heavy-duty investors, by the retail public, all of us. So they're moving slowly, and they're actually building the infrastructure in a very scaled manner, creating blockchain consortiums, building the infrastructure, testing it, getting it ready, I would say, for the minute that the regulator would be saying, yes, please go ahead and do custody over permissionless blockchains or whatever it is they do decide. We see them working, creating dozens of people, of departments to be able to address the challenges in a timely manner.
Thank you for the answer. Adam, let's kick it to you. You're about to jump in.
Yeah, I was going to say, I would say that the scaling is already upon us. I think that that's the catalyst that's necessary to really enable, traditional financial institutions and this new wave of neobanks and other new fintech companies to really confidently offer crypto-based financial services and products to their customers. And I think we're there actually with technologies like we offer and other companies like Unbound and like some of our partners that we're doing an AML KYC like CipherTrace and others. I feel like now is the inflection point where the infrastructure is there. And what I was going to say with regards to scalability is that's not only important, that's sort of mission critical. I look at it, I said before, Web 2.0, but take a step back even further. Think about it this way. I think the kind of technologies that we're talking about today, they are sort of infrastructure level like the web, HTTP, right? HTML protocol. They enabled so many new businesses, right? So when we talk about any given use case, like I'm a major financial institution, I want to offer crypto custody services to my customers, so that they can hold a balance in, say, crypto assets or digital assets. It doesn't even need to be crypto. It could be digital RMB or the digital USD, right? Or I want to provide trading, or I want to provide more advanced kind of things like Rebecca was mentioning with derivatives or swaps, or I want to provide, all these type of advanced sort of high frequency trading and all the things that are in the equities markets. We are reinventing the whole financial system here based on digital assets. And the technology we're talking about today is really that infrastructure level, like HTTP and HTML, that spawns all these other things, right? So that's where I think it is. And if you think about those technologies and how fundamental they were to scaling the internet, scale, you're right, Frank, it's sort of like table stakes. That is sort of the fundamental requirement in order for these things to go mainstream and to go global. And I actually think we are there. And I think exactly this kind of platform that Sal's talking about today is the type of solution that will give regulated, compliant financial institutions confidence to get there.
Through a little bit, Sal, through that new product that you guys have just launched.
Yeah, absolutely. So go ahead.
No, like who's it aimed at? Who is set to sort of start using it? Any big names?
Yeah, so I'd rephrase it from a products to accelerator in the context that yeah, so when you look at the work that we're doing around the solution called Chain Fusion, it's a build process that facilitates a series of known archetypes around implementation models of these types of mature data infrastructure providers, node infrastructure providers, custody capabilities in a known environment, so that as we go to market and enable client adoption of these respective technologies, we can leverage the data that's generated in their respective processes in ways that facilitate automation to support compliance and risk management objectives. And when you break down what that means in terms of enabling trusted adoption, it's core. Right now, there's a lot of or a lack of understanding across the tier one institutional landscape in terms of what it takes to build out these capabilities leveraging third-party tech. So how do you bring those things in-house with a trusted service provider who's invested time, energy, and effort to not only build go-to-market relationships, but also consume the technology, right, and understand the intricacies of how the technology can be leveraged to not only drive these objectives around security, risk management, and compliance, but also to enable new types of product innovation. Which is some of the thinking that we bring to market around this collective group in terms of, how do you leverage MPC to enable new types of staking and pooling products, and how can MPC change the way in which not only DeFi applications are constructed, but how those things are bridged into central finance, and how lending products that exist today could be reinvented and optimized substantially by deploying. So, again, super excited about the work our team has been doing, thinking inspired by Sam Weiner, who's the co-lead of all things crypto at KPMG. And really today is the culmination of a journey that has kind of persisted over the last 18 months and will really flourish in the market over the next 6. So I'll pause there. Hopefully that was a quick primer for you guys. I'll stray away from dropping large client names today, but I'm sure that you folks will see press over the next 6 months with regards to who those are.
We'll be closely watching and monitoring Sal at the block. There are a lot of different companies in the space that are trying to help larger institutions understand the complexities, the intricacies of this technology, to your point, Sal, so that they can then leverage it. We mentioned security tokens early in the conversation. We've seen almost a shaking out of that industry. Open Finance was in the news recently. They've recently laid off one of their co-founders. Harbor was sort of bought up by BitGo after a series of failures. And then this broader backdrop of COVID-19, right? And this upcoming potential, or rather this ongoing financial crisis and health crisis. And at the same time, you have so many providers trying to do this. They're innumerable, working on things like MPC, which we can dive into later. Is there a possibility, and I think this would mimic, the Web 2.0 era and previous eras of new technologies coming on, but is there right now just too many service providers? This is kind of a business perspective question. For the too few investors or end clients? And how do you see that shaking out, sort of panning out?
I would like to take this question, if I may.
You may take it away.
During the last 3 years, I would say, I've had the pleasure of meeting these enterprise-grade type of customers. And one of the most repetitive type of comments is, oh, blockchain is just for the, crazy out there kids that are doing Bitcoin, etc. So it may sound even harsh, but the fact that the market is consolidating and the serious guys and the serious solutions and the serious vendors are staying and consolidating, in the sense that the bigger ones are buying the smaller ones, and the ones that don't have enough added value are getting out of the market, is actually a good sign for the market. It's actually a good sign of a maturing market that would leave the bigger ones, the stronger ones, the ones that bring added value upfront to a place where the customers would feel more at ease with buying such solutions. That's my point of view.
I couldn't agree with you more, Rebecca. I think the shakeout in the industry is a sign of maturity, and it happens in all industries. And it means that the companies that are successful are the ones providing the value and providing the scalability. And I think there's a lot of value in companies coming together, like ours are, in order to provide an overall platform and solution. It's important to recognize that you can't do everything yourself. And I don't think that large financial institutions want to just rely on one company either, right? They want to mitigate risk a little bit as well. And so, you know, the truth, though, is that even though we're all very proud of how large crypto is today, it's this big compared to the traditional financial markets, right? So I think the opportunity is huge. It's a huge greenfield out there. There's room for everyone, but there is that maturity of the industry where you're going to get companies, you know, who do fade away and the strong survive and come to sort of consolidation along the lines of making strong companies stronger and helping to accelerate growth and whatnot. And I still, though, I think there's plenty of room for competition. We'd love to see the competition because there's just so many people that haven't been touched by this technology yet.
Mm-hmm.
I'd like to close. I was going to say,
Go
I'd
ahead.
love to throw one comment on there, Frank, just in regards to, you know, I think the capital allocation cycle following 2017 got far more sophisticated and intelligent and drove the phenomenon and shakeout that we've seen today. And I think the companies that are leading in their respective domains have legs in many cases, and I think have primed in a way that they're preparing to cater to a demand cycle that has continued to be, to some extent, elongated relative to what I think early mover or first perspectives were in terms of timing. But that being said, those that have legs and carry through this time frame for that institutional adoption cycle over the next 18 to 24 months, I think that you're really going to start to see the demand side swell in a way that the competitive landscape in the market today is substantiated by, you know, a demand cycle that is fairly strong and significant and aligned in timing as well. When folks move, they will all move in sync to some extent.
I think that's a fair point. Before we dive into some of the more granular aspects of maybe something like MPC, I want to and go back to one of my questions about custody and custody at large financial services firms, because it was basically the focus, if you harken back on to 2018, 2019, when you thought about all of these large banks working in the crypto space, it was on internal pilots around custody. I'm thinking of Goldman Sachs. What happened to that? Adam, you made a very good point about the market being really tiny, right? So when the price sort of dips, interest dips alongside of it, and there are also all these headline risks. So when we see something like Goldman Sachs, for instance, rolling out crypto custody or digital asset custody, will it have to, in a sense, this is a loaded question, come to fruition vis-a-vis a third-party vendor as opposed to them sort of going about it alone, which seemed to have been what people were thinking back in 2018.
Yeah, it's not an all or nothing thing either, Frank, right? So there's different levels of value proposition. Okay, so if you think today, mobile phones are largely commoditized. Most mobile phones today look just like an iPhone. You know, the value add that Apple provides is more in the software, and it's the app ecosystem on top of that, and the status of that logo probably as well. But my point is that companies will focus on what they do best and what their differentiation is, and they'll buy everything else because it doesn't make sense to reinvent the wheel. Everyone used to run their own data centers. They used to have all their servers in-house. They used to have colo facilities. Now they use AWS or Azure or technologies like that, right? It's cheaper, can scale better, and ultimately provide someone with a lot of benefits that they couldn't get at the scale that they are. The same thing is happening here. But you bring up a really good point. What happened at Goldman? What happened to that JPM coin? Remember the JP Morgan coin? What happened to all those things, right? I think what happened is they looked at it, and I think they got concerned about regulatory risk, especially when they saw what happened to Libra, Facebook, right? They got concerned about the costs, right? And they looked at the software industry, and they couldn't find good scalable solutions a couple of years ago for this kind of technology. Now I think things are changing. When you get trusted, respected companies like KPMG, other audit tax system integrators also providing these comprehensive platforms that plug in best-in-class technology from multiple companies, right? Then you start to think, well, maybe I can bring a product to market like this. And then it's these proactive, progressive banks that use these new technologies, or financial institutions that use these new technologies to get ahead of the competition. And I think because of what Apple did when they decimated the music industry and the movie industry in Los Angeles, right? I think that business executives are learning. They don't want to get decimated. They want to be the Apple. They don't want to get killed like the record companies got killed, right? And so they're embracing new technologies like this, but they have a certain level of expectations. It's got to scale. It's got to have a good user experience. It's got to be reasonable cost, right? And then they've got to be able to add their own value add on top, whatever that is, they do, right? And I think that's exactly what we're talking about today. And I think we're ready for that. I think it's the right time.
And even within cryptocurrencies, even within our ecosystem, there's skepticism around new technologies within the ecosystem. We're thinking of things like MPC, for instance, serves as a great example. When it first sort of came online, and Rebecca can definitely speak to this, it was met with great skepticism, right? The way we had always stored or secured assets in this space, or at least the way that was always thought of as being the most secure, was cold storage. And then from cold storage, you had MPC and different technologies like what we're seeing out of Anchorage. And so different theses and theories of how these assets should be stored, not to mention whether or not we should be even engaging with them in the first place, that those narratives have changed as well. I'd be interested to hear sort of that evolution or how that evolution transpired from your perspective, Rebecca.
Yes, it is still a challenging journey in the sense of gaining at least the risk-averse type of customers' trust, certainly the mass community. So we treat it very much like that. It's a journey, and we respect every early adopter that is getting into the list of the customers that we're very proud to serve. We respect every deal that is starting, I would say, maybe with a small, MPC type of environment, and then replacing more and more HSMs, just as an example. So it's a journey, and we're very much respectful of it. And with any journey, any type of revolution, it starts with the early adopters, and a few years from now, I'm certain it's going to be in every organization, not just, as starting point, but revolutionizing the way that we protect data, the way that we protect keys and secrets.
A really good point. I want to move on soon to the questions we have from the audience, but I want to touch on regulation for just a moment. I was talking to an executive in the space the other day about what the bank clients he serves require from a regulatory perspective. Are companies like Blockset or Unbound, are they supposed to be regulated like technology companies, like financial services companies? And what do those clients expect? And the executive had a pretty interesting point, which was, well, at the end of the day, the services and tools we provide to our clients equip them with the ability to then audit better, to then understand where the money is coming from, so to speak. I'd be curious to know what are some of the regulatory questions that hang over the space right now, and what do your clients expect from you on the regulation front?
So maybe I can start here. We see with the custody type of request that they require, I would say, 3 types of custody, or at least turn in between those 3 types. It could be full custody, as we expect the bank to deliver. It could be partial custody or co-managed custody. So it could be in the sense of multi-signature to have the keys shared between, let's say, the customer and the vendor. And it could be fully or non-custodial type of solution where the consumer, usually the consumer would be the one responsible for the key. So between these three types, we see regulations all over the world sort of evolving. The FSA, in Japan. We see the German Banking Act in Germany. We see the FinCEN guidelines in the United States requiring minority of keys or majority of keys to be defined as a custodial or a non-custodial or managed custody. And the vendors would have to probably, I would say, even dance between those different options, deciding if they want to be non-custodial and therefore move the responsibility for the key holding to the consumer or to the investor, or co-manage investments and keys for that matter, or become a full custodian, therefore be pretty much like any bank, meaning I trust you as a bank, I as an investor trust you as a bank. So these three types, depending on the regulation and the preference, I would say, of the vendor.
Mm-hmm. Mm-hmm.
Say that when customers come to us for the Blockset product, they're looking for a trusted data source so that they can use the information regarding blockchain data in order to, in some cases, perform whatever regulatory or compliance related checking that they need to do or auditing, right? So they need a trusted, reliable way to get that data. And then we, also think it's important to partner with companies that focus specifically on like AML or wallet address monitoring or different aspects of KYC, so that as requests like go through our platform, that those financial institutions making the requests can also get that associated metadata, right? That might be available regarding the transaction that might flag it, for example, for suspicious activity or something of that sort. But I will say this: I think overall in the industry, sort of from the beginning, there's been this perception that we all, in the crypto space in general, are outside of a lot of that regulatory, sort of in compliance requirement. If you go back to sort of the Bitcoin maximalist theory, that's absolutely not possible. You have to play by the rules if you want to run legal, compliant, and scalable companies. And all companies in the crypto space are moving that way. And the trick is this: how do you keep the user experience good enough for the end user so that you can onboard and bring people in and get them interested in these products and services, while at the same time making sure that you're compliant and regulated? And that's the hard part. The companies like E-Trade did that 20 years ago. They spawned a whole new activity of consumer investing, right? And companies, like some of ours here today are trying to do the same thing right now for crypto.
Mm-hmm. Mm-hmm. It's a good point. Trying to sift through some questions here. I guess since we're on the topic of regulation, what do you think is the expected impact of some of the upcoming or updated regimes when it comes to regulations? We have Wyoming sort of working on its own thing, the German Banking Act, the Japanese FSA, on sort of, trying to shape how this space will be monitored and surveilled and regulated. Do these shifting landscapes and often this patchwork of regulatory situations or environments, is that an impediment maybe for new blood, new clients to sort of engage with this market?
Yeah.
Maybe this
Yeah,
is
I
a
think I
question
can
for Sal.
first add there. So the regulatory complexity obviously has been a challenge for a period of time. I think it's to some extent that the cost of compliance has been significant, but similar to the product companies that serve the data infrastructure, node infrastructure, and custody space, there are providers like Cipher that provide those on-chain analytics capabilities to support the build-out of robust AML programs. And when you think about the chain fusion capability that we're describing today, the AML use case and programmatic viewpoint is one that it serves very well. So by aggregating data around off-chain transactional activity in the context of an exchange with on-chain transactions and on-chain asset provenance assessments, as part of a broader program that embeds AML typologies, rule sets, and thresholds that are, embedded from regulatory structures, but within the context of each jurisdiction you deploy. Those are the types of solutions that really are enabling this enhanced compliance. So, it is obviously a continual challenge, and I think it's an interesting space to look at continuing moving forward, especially as it pertains to how those regulatory drivers impact the ops model of the business and the infrastructure layout. How do you rebalance assets in context of the SFC guidance on 98% cold storage versus 2% hot? How do you manage regulatory requirements for jurisdictional location of physical hardware, should that be the circumstance, as we're seeing in Wyoming?
Yeah, and each state is each jurisdiction is going to have their own expectations. From your perspective, Sal, or maybe the perspective of some of the clients you're engaging with, is the preferred model that patchwork where you kind of have maybe different forms of regulatory innovation, or do we just need, or do clients need just one blanket of regulation so that, to your point, when I'm looking at these various intricate aspects, maybe it's accounting, maybe it's how I'm supposed to store these assets, it seems at first glance that it would make more sense for it to just be a blanketed situation.
Yeah, I mean, the increasing adoption of cohesive regulations, FATF taking a significant step forward in doing that, but also practices from smaller jurisdictions that were more agile and move first, like Malta, influencing the thinking in the EU and subsequently propagating thinking to Canada and the United States. But at the end of the day, when you think about the value that we provide from a services perspective, is that we are a global firm embedded in all of these different regulatory regimes and structures. So when you think about a global adoption strategy in the context of a large company, we have boots on the grounds and can build baselines for unified compliance that allow organizations to dynamically operate across different jurisdictions. So obviously there's a lot of complexity. We'd prefer unification and harmonization to the extent that it protects markets and investors. But at the same time, we do appreciate it's a long journey. So we're here to help along the way.
I'll just add to that. I would say two things. One, it's an important part when you're defining a new product as a financial institution to consider these licensing, regulatory, jurisdictional issues and requirements, whether it be a state-by-state basis or a country-by-country basis. So you've got to factor that into the product requirements. In addition to that, then your platform that you choose has to have kind of a layer, if you will, right, to kind of handle each of these different things. Now, the good news is that those technologies are now available. Those are some of the technologies we're talking about today. They haven't been available, for a long time. So it's good that they're out there. So these things are now possible. And then from the perspective of the clients of companies like ours, I'd say there's good news and bad news overall, right? And the bad news is that they've got to deal with this, and it's got to be factored in, as I just said. But here's the good news: they've been doing this for a long time. These same issues existed in fiat; they existed with equities. It's always local government, state, or national government specific, and they're very used to doing that. And so it's not worse. In fact, it's actually better because they're comfortable with those sort of restrictions. They're comfortable with how to operate legally, audit, tax, all that kind of stuff, right? And they know what they're doing. So this fits into that paradigm that they're comfortable with. And now software is available to help enable that for these kind of new digital asset technologies.
Fair enough. And I think an important thing to note is that it also varies by asset and depending on whether or not you're dealing with a public or private blockchain. We got a question from Joseph Wachira, I think is how we'd pronounce it. And it was, what do you think the future looks like for private coins like Monero, Zcash, among others? Are governments feeling threatened that they won't be able to collect their taxes? Or would they feel threatened, given maybe the adoption of some of these cryptos? How do you think governments are going to react in dealing with that threat of some of these private coins? It's an interesting question. It's kind of tangential to the conversation, but interesting.
Yeah, so I'll take a very quick stab. I think ultimately the advances in privacy technology will become ubiquitously adopted across layer 1 protocols. So whether it's an incarnation of some degree of a bulletproof or some type of approach using ZK snarks or whatever the setup structure is, We can expect privacy tech on layer 1 in some context at some point, which begs the question around selective disclosure. So obviously, all of us have the responsibility as individuals to report to our respective tax authorities, and we can, as you look at kind of the Zcash model with selective disclosure, provide the ability to do that. So, you know, there's always about a balance between regulation and privacy, and this is kind of the core of that in a technical incarnation. Stay away from like the philosophical side, but I think, you know, from a tech perspective, we can expect the challenges around privacy, monitoring, taxation, reporting to be things that persist in the future.
Fair enough. Well, I think we're getting close to the hour mark. My colleague, Ryan Todd, wanted to propose a question from the audience. Ryan, is Ryan still on the line with us? I guess he's not. So let me take a look at, he is not. He said, just read the question, Frank. All right, I will read it. I wanted him to get some action on this. I feel like I've been, you know, hogging up the spotlight as I often do. Okay, so the question is, what is the actual real value proposition of this technology? It's a broad question from a financial market infrastructure perspective. And is it compelling enough against the status quo? So that's one question. Or, as one participant wondered in the question area of the chat, has it been easier to sell the idea that digital assets are intricate and must be explained, and that this is an upcoming paradigm shift? So I'd be interested to get everyone's hot take on that.
I'll start, Frank. I would say this. So it's a
Sure.
really sort of leading question in so much as, are there real customer pain points and use cases for this stuff? Right? I mean, that's what we're really getting at. And so I look at real business opportunities in that mindset. A really great example of someplace that digital assets are being used right now is in remittance. You know, here in Tokyo, where I am right now, there's, you know, tens of thousands of immigrants every day who are hourly workers here in Japan who send money back to their countries in Southeast Asia or other places around the world. And using, you know, certain kinds of digital asset technologies, we don't have to get into the details of the companies and everything else. You know, that's a real use case, and that really happens, right? And so, you know, and some of that technology happens to use our product, but it's less about the products, right? It's more about, I think the real question maybe that is being asked is there a value proposition to use digital assets for the end user or for the actual customer, right? And the answer to that is it's the responsibility of the financial institutions or the fintech companies in order to figure out how to leverage the technologies in order to do that. Because right now we kind of look at it, the question sounds to me like, hey, 20 years ago, is the web better than what exists today? Or is email better than postal mail, right? Well, you know, the web is better than what we have today. Now, the definition of disruptive technology is not that it makes something better, it's that it makes the old system irrelevant, right? And I think it's based, though, on certain use cases where there's real value, right? And so what we're doing is we're providing the building blocks, we're providing that infrastructure. And then it's our customers, another set of companies who understand regulation, compliance, they have huge customer bases. They're going to use these building blocks to create a new economy based on digital assets, but they've got to do a really great job of managing user experience and providing value, right? But the good news is that, and what we're really talking about today, is that those building blocks now exist.
What's your take, Rebecca?
I muted myself. Again, very happy for the question. Thank you. 2 years ago, I was at a situation where I had to explain, even internally, to the enterprise security people within my company why blockchain is needed. The question does not come up anymore, I must say. It is not if it's needed, the use cases are already there. They're being very much clear, whether these are private blockchain consortiums, whether these are permissionless blockchains. It is just the question, I would say, today of how friendly are the regulators to these types of organizations, and trust, the issue of trust and security for that matter, because at the end of the day, with blockchain, the asset is the key and the key is the asset. So I can certainly understand people who are still, I would say, skeptic, but we're already there. We're already there.
Fair enough. Well, Sal, maybe we should get your hot take on that.
Yeah, no, I'm completely aligned. I think the discussion that we had today, I think the representative products that we've covered demonstrate, where we stand in kind of the adoption cycle. And I think, we're on the verge of a very exciting event, despite where directional, prices might go over the next several days. But I think if the hypotheses of many of the folks that have driven this ecosystem to the point it is today hold true, the next 6 to 9 months from the institutional side might be something we've never seen before. So, obviously that's predicated on a hypothesis of price movement in one direction versus the other. But, either way, it's an exciting time. So happy to be here with both Rebecca and with Adam today. I think great discussion, Frank, and appreciate your
thank you.
kind and insightful guidance.
Thank you.
Folks, we had a good number of folks, hundreds of folks on for the discussion today. This was our first discussion. We're probably going to do others in the future where we get a little more granular. This was a nice open-ended, wide conversation. So to the extent that any of you have any suggestions for future topics for webinars, we would be very much keen on hearing those suggestions. But regardless, thank you so much, everyone. Adam, Rebecca, Sal, thank you so much for coming on. And everyone else, stay groovy.
Thank
Thank you,
you.
Frank. Appreciate the
Thank you
opportunity.
so much.
Au revoir.
Frank, thanks, Adam. Thanks, Rebecca.